Good evening. Global financial markets are once again responding to developments in Washington, as recent shifts in U.S. trade policy are creating noticeable ripples across stocks, currencies, and commodities worldwide. While trade policy discussions may sound technical, their impact is anything but abstract. Decisions made by the United States, the world's largest economy, influence how companies invest, how currencies move, and how confident investors feel about the global economic outlook. At the center of the current market reaction is renewed uncertainty surrounding tariffs and trade negotiations. Over the past several weeks, statements and policy signals from U.S. leadership have raised concerns among investors about the possibility of new or expanded trade barriers. Even without immediate implementation, the prospect alone has been enough to trigger volatility across major financial markets. U.S. stock markets have experienced sharp intraday swings as investors react to policy headlines in real time. Major indexes initially declined following reports of potential tariff measures affecting key trading partners, before partially recovering when officials suggested negotiations were still ongoing. This pattern, sell first, reassess later, reflects how sensitive markets have become to trade-related developments. The reason trade policy carries such weight lies in its direct effect on corporate costs and global supply chains. Tariffs increase the price of imported goods, which can reduce profit margins for businesses or lead to higher prices for consumers. Companies that rely on international manufacturing or overseas suppliers are particularly exposed, making sectors such as retail, technology, automotive, and industrial goods especially vulnerable to trade uncertainty. Currency markets have also reacted swiftly. The U.S. dollar has seen fluctuations as traders weigh the potential economic impact of trade restrictions against the dollar AS traditional role as a safe haven currency. In some sessions, the dollar strengthened as investors sought stability amid uncertainty, while in others, it weakened on concerns that prolonged trade tensions could slow U.S. economic growth. Beyond the United States, global markets are closely watching these developments. European and Asian stock indexes have mirrored Wall Street's volatility, underscoring how interconnected today's financial system has become. When U.S. trade policy shifts, exporters, manufacturers, and investors around the world must adjust expectations almost instantly. Commodities, particularly gold, have been another focal point. Gold prices have risen as investors look for assets that traditionally perform well during periods of uncertainty. This move suggests growing caution among market participants, even as broader economic indicators such as employment and consumer spending remain relatively stable. Economists emphasize that the current situation is not solely about tariffs themselves, but about predictability. Markets tend to perform best when policy direction is clear and consistent. Uncertainty, especially when tied to international trade, makes it harder for businesses to plan investments, manage costs, or forecast earnings. That uncertainty is often reflected in higher market volatility. U.S. officials have stated that trade measures are being considered as part of broader negotiations aimed at protecting domestic industries and addressing trade imbalances. Supporters of this approach argue that stronger trade enforcement can benefit certain sectors and improve long-term economic competitiveness. However, critics warn that aggressive trade actions risk retaliation from trading partners, potentially leading to slower global growth. So far, there has been no full-scale escalation, but markets are reacting to the possibility rather than the outcome. This highlights an important dynamic in modern financial systems. Perception can move markets just as powerfully as policy itself. A single statement, even without immediate follow-through, can shift billions of dollars in market value within minutes. Central banks are also monitoring the situation closely. And while monetary policy remains focused on inflation and economic growth, prolonged trade uncertainty could influence future interest rate decisions. If trade tensions were to significantly slow economic activity, central banks may be forced to adjust their outlooks. For everyday consumers, the effects may not be immediately visible, but they are not insignificant. Over time, trade disruptions can affect product prices, availability of goods, and even job stability in trade-dependent industries. That is why investors, policymakers, and households alike are paying close attention to how this situation unfolds. As markets continue to respond to developments from Washington, one thing remains clear. U.S. trade policy is not just a domestic issue. Its influence reaches far beyond national borders, shaping global market sentiment and economic expectations worldwide. Market analysts say one of the most significant challenges right now is that businesses are being forced to make decisions in an environment where rules may change quickly. Large multinational companies often plan production, sourcing, and investment years in advance. When trade policy becomes uncertain, those long-term plans can be delayed or revised, which in turn can slow overall economic momentum. Several major corporations have already noted in recent earnings calls that trade uncertainty is affecting their outlook. Some executives have pointed to higher input costs, while others have cited difficulties in forecasting demand due to changing trade conditions. Even companies that are not directly involved in international trade can feel secondary effects, as shifts in supply chains and pricing ripple through domestic markets. Small and medium-sized businesses may be even more exposed. Unlike large corporations, smaller firms often lack the financial flexibility to absorb sudden increases in costs or to quickly change suppliers. For these businesses, even modest tariff changes can have an outsized impact on profitability. This is one reason business confidence surveys are being closely watched by economists as a leading indicator of broader economic trends. Investors are responding by becoming more selective. In recent trading sessions, there has been a noticeable rotation in market leadership. Companies perceived as more domestically focused or less dependent on global supply chains have at times outperformed those with significant international exposure. At the same time, sectors tied closely to global trade, such as manufacturing and transportation, have faced periods of increased selling pressure. Bond markets are also sending important signals. U.S. Treasury yields have moved as investors balance concerns about economic growth with expectations for future inflation. In times of heightened uncertainty, government bonds are often viewed as a safer place to park money. Increased demand for these assets can push yields lower, which in turn influences borrowing costs across the economy, from mortgages to corporate loans. International reactions have been equally important. Trading partners of the United States are closely monitoring policy developments, not only to assess economic impact, but also to determine whether retaliatory measures might be considered. History shows that trade disputes can escalate quickly when multiple countries respond with their own tariffs or restrictions. Markets are therefore factoring in not just U.S. actions, but the possibility of responses from major economies in Europe and Asia. Financial institutions and global organizations have also weighed in. Some have cautioned that prolonged trade tensions could reduce global growth rates, particularly if uncertainty discourages investment in cross-border trade flows. While forecasts vary, there is broad agreement that sustained policy unpredictability makes it harder to maintain stable economic expansion. At the same time, U.S. officials have emphasized that negotiations remain ongoing and that trade tools are being used as part of broader strategic discussions. From this perspective, trade pressure is seen as a way to bring partners to the negotiating table. Supporters argue that this approach can lead to agreements that better reflect U.S. economic priorities. However, markets tend to focus less on long-term strategic goals and more on short-term risks, which is why volatility often increases during periods of active negotiations. Another area of attention is inflation. Tariffs, by their nature, can raise the cost of imported goods. If those higher costs are passed on to consumers, inflationary pressures could increase. Central banks must then consider whether rising prices are temporary or part of a longer-term trend. This makes the policy environment even more complex as monetary authorities attempt to balance growth, inflation, and financial stability. For consumers, these developments can gradually show up in everyday life. Higher prices on certain imported goods, from electronics to household items, may become more noticeable over time. In addition, if businesses face higher costs, they may respond by slowing hiring or reducing investment, which can affect job growth. While these changes often happen gradually, they contribute to the broader economic picture that policymakers and investors are trying to assess. Market psychology also plays a major role. In today's fast-moving information environment, headlines can spread globally within seconds. Automated trading systems and algorithmic strategies can amplify market reactions, leading to sharper short-term movements. This means that even relatively small policy updates can trigger significant swings, especially when markets are already on edge. Despite these challenges, many economists point out that the underlying U.S. economy still shows areas of strength. Consumer spending, employment levels, and certain business investment indicators remain relatively solid. This has helped prevent more severe market declines, even as uncertainty persists. The tension between strong current data and uncertain future policy is one of the defining features of the present market environment. What makes this moment particularly important is the role of the United States in the global financial system. Because the U.S. dollar, financial markets, and trade relationships are central to the world economy, changes in U.S. policy tend to have outsized effects. This is why investors in regions far from Washington are paying close attention to developments, even when they are not directly involved in the negotiations. As this situation continues to evolve, markets are likely to remain sensitive to every new signal from policymakers. Investors will be watching not only official announcements, but also comments, interviews, and informal statements that could hint at future direction. In this environment, clarity and consistency will be key factors in restoring greater market stability. Another key factor shaping market reactions is the timing of these trade policy discussions. They are unfolding at a moment when the global economy is already navigating multiple pressures, including slowing growth in some regions, geopolitical tensions, and ongoing adjustments to higher interest rates. Against this backdrop, any added uncertainty from trade policy can have an amplified effect on investor sentiment. In recent years, global supply chains have become highly optimized, designed to minimize costs and maximize efficiency across borders. Even small disruptions can have wide-ranging consequences. When companies face uncertainty over tariffs or trade rules, they may choose to delay shipments, stockpile inventory, or seek alternative suppliers. These adjustments, while often necessary, can reduce efficiency and increase costs across the system. Emerging markets are also feeling the effects. Many developing economies depend heavily on exports to the United States, either directly or through global supply chains. When U.S. trade policy becomes unpredictable, currencies in these countries can come under pressure and capital flows may slow. Investors often pull back from riskier assets during periods of uncertainty, which can make financing more expensive for emerging economies. Financial markets are reflecting these concerns. Volatility indexes, often seen as a measure of market anxiety, have shown periods of elevation following trade-related announcements. While volatility alone does not signal a crisis, sustained increases can indicate reduced confidence and a higher level of caution among investors. Corporate investment decisions are another area under close scrutiny. Businesses tend to invest more when they have confidence in future demand and stable policy conditions. Prolonged trade uncertainty can lead companies to postpone capital expenditures, such as building new factories or expanding operations. Over time, this can slow productivity growth and limit economic expansion. Labor markets may also be affected. While employment remains relatively strong in many sectors, trade-dependent industries can face challenges if costs rise or demand weakens. Manufacturers, exporters, and logistics firms are particularly sensitive to changes in trade conditions. Any slowdown in these areas can have knock-on effects throughout the economy. Policymakers are aware of these risks, and some have emphasized the importance of maintaining open lines of communication with trading partners. Diplomatic engagement, they argue, can help reduce misunderstandings and prevent disputes from escalating. Markets often respond positively to signs of dialogue and cooperation, which can ease fears of abrupt or punitive measures. At the same time, political considerations play a role in shaping trade policy. Domestic economic priorities, concerns about competitiveness, and public opinion can all influence decision-making. This adds another layer of complexity for investors, who must assess not only economic fundamentals, but also political dynamics that may affect policy outcomes. Market strategists note that this environment requires a different approach from investors. Rather than reacting to every headline, many are focusing on long-term fundamentals and diversification. By spreading exposure across regions and asset classes, investors aim to reduce the impact of sudden policy-driven swings. Still, even diversified portfolios are not immune to global shocks when uncertainty is widespread. The role of communication cannot be overstated. Clear and consistent messaging from policymakers can help stabilize expectations, even if difficult decisions are being considered. Conversely, mixed signals or abrupt changes in tone can heighten uncertainty. In today's markets, where information moves instantly, communication itself has become a powerful economic tool. Technology is also shaping how markets respond. High-frequency trading and algorithmic systems can magnify price movements when certain keywords or policy signals appear in news reports. This can create rapid reactions that may not fully reflect long-term economic realities, but still influence short-term market behavior. Despite these pressures, it is important to note that not all sectors are affected equally. Some industries, particularly those focused on domestic services, are less directly exposed to international trade. These areas have provided a measure of stability during periods of trade-related volatility, helping to cushion broader market movements. Global institutions continue to emphasize cooperation as a means of sustaining growth. International trade, they argue, has been a key driver of economic development over decades. While reforms and enforcement may be necessary, abrupt disruptions can carry significant costs. This perspective is shared by many economists, even as debates over trade policy remain politically charged. As investors look ahead, attention is shifting toward potential scenarios. One possibility is that negotiations lead to clearer frameworks and reduced uncertainty, which could support a rebound in confidence and investment. Another is that prolonged uncertainty becomes the norm, leading to ongoing volatility and cautious behavior across markets. The path chosen will have meaningful implications for growth, employment, and financial stability. For now, markets remain in a waiting mode, reacting to each new development while trying to assess the bigger picture. The balance between economic strength and policy uncertainty continues to define trading behavior. This tension is likely to persist until there is greater clarity on the direction and scope of U.S. trade policy. As events unfold, the global economy stands at an important crossroads. Decisions made in the coming months will shape not only trade relationships, but also investor confidence and economic momentum worldwide. The stakes are high, and the markets will continue to signal how these developments are being interpreted in real time. As investors and policymakers assess the situation, one consistent theme emerges. Markets are not reacting to a single decision, but to an evolving policy environment. The absence of definitive outcomes has kept uncertainty elevated, and that uncertainty itself has become a central force influencing financial behavior. In this context, markets are continuously repricing risk based on the latest signals from Washington. Historically, periods of trade tension have shown that even temporary disruptions can leave lasting impressions. Businesses that adjust supply chains or delay investments may not immediately reverse those decisions, even after uncertainty fades. This means the economic effects of trade policy debates can extend beyond the headlines and persist well into the future. Financial markets, however, are forward-looking by nature. Traders and investors are constantly trying to anticipate not only what policymakers will do, but how others will react. This creates a feedback loop in which expectations shape market movements, and those movements in turn influence confidence. In such an environment, stability often depends as much on perception as on policy substance. One area drawing increasing attention is the potential impact on long-term growth. Trade has historically supported economic expansion by allowing countries to specialize, increase efficiency, and access larger markets. When trade flows are disrupted or become less predictable, those benefits can diminish. Economists caution that reduced trade openness, even temporarily, can weigh on productivity and innovation over time. At the same time, there's recognition that trade policy is not one-dimensional. Governments must balance economic efficiency with concerns about fairness, security, and domestic industry resilience. These considerations help explain why trade debates can be complex and politically sensitive. Markets, however, tend to focus on measurable outcomes, such as costs, earnings, and growth prospects, rather than broader strategic goals. Central banks remain a stabilizing force in this landscape, but their role is not unlimited. Monetary policy can support demand and manage inflation, but it cannot fully offset the effects of prolonged trade uncertainty. This reality has led some policymakers to stress the importance of coordination between fiscal, trade, and monetary strategies to maintain economic stability. For global investors, the current environment reinforces the importance of adaptability. Market conditions can change quickly, and trade-related developments often occur with little warning. This has encouraged a more cautious approach, with greater emphasis on risk management and flexibility. While volatility presents challenges, it also reflects markets actively processing new information. Consumers, meanwhile, may continue to experience the effects more subtly. Changes in prices, product availability, or employment conditions often emerge gradually. Still, the cumulative impact of trade uncertainty can influence household confidence and spending decisions, which are critical drivers of economic activity. Internationally, the response to U.S. trade policy developments highlights the interconnected nature of today's economy. No major market operates in isolation, and actions taken by one country can quickly influence conditions elsewhere. This interconnectedness amplifies both risks and opportunities, making cooperation and communication increasingly important. As negotiations continue and policy discussions evolve, clarity will remain a key factor. Markets generally respond favorably when there is a clear framework and a sense of direction, even if challenges remain. Conversely, ambiguity and shifting signals tend to sustain volatility and caution. Looking ahead, much will depend on how trade discussions progress and whether they result in more predictable rules for businesses and investors. A move toward clearer agreements could help restore confidence and support growth. On the other hand, prolonged uncertainty may continue to weigh on markets and investment decisions. What is clear is that U.S. trade policy remains a powerful force in shaping global financial conditions. Its influence extends beyond trade flows, affecting currencies, asset prices, and economic expectations worldwide. As a result, developments in this area will continue to command close attention from markets around the globe. In the weeks and months ahead, investors will be watching not just the outcomes of trade negotiations, but also the tone and consistency of policy communication. In an environment where information travels instantly and reactions are swift, how policies are conveyed can be nearly as important as the policies themselves. For now, global markets are navigating a period defined by caution, adjustment, and anticipation. The situation remains fluid, and responses will continue to evolve as new information emerges. As always, markets will serve as a real-time indicator of how these developments are being interpreted and priced. Ultimately, the story unfolding is about more than tariffs or trade talks. It is about confidence, predictability, and the balance between national priorities and global integration. How that balance is managed will play a significant role in shaping the economic outlook in the period ahead. That is why U.S. trade policies are shaking global markets, not because of a single decision, but because of the far-reaching implications they carry for the world's interconnected economy.